Good evening, everyone. My name is Paul Young. I'm just going to walk you through business startups in Canada, kind of a bit of a review and analysis. This presentation, again, is just my view and perspective of things. It's not deemed to be the only solution or options available for people that are considering doing startups. It's kind of just to give you a little bit of data. A little bit about myself. I'm a CPA CGA professional accountant by trade, but I've got 25 years of business experience. I've also got experience in academia as well as industry, so I kind of understand what it takes to compete. That being said, this presentation is going to do a high-level view of the issues facing startups, and I'm going to probably emphasize some of the issues that may come into play that you need to think of as part of looking at those markets, whether you want to do a startup or whether you want to invest in a startup. I'll talk about what is a startup. I'll talk about startup versus small business. Why do they fail? I'll talk about why startups succeed. I'll talk about compensation, how they kind of pay people out. I'll talk about government involvement. I'll also just talk a little bit about the private sector as well. And then I'll just give you the 20 fastest growing companies from 2015. What is a startup? Typically a startup comes into a niche market. Usually they've got some sort of background. And basically what they do is they're targeted at a solution. So they're very aggressive. They get into that market and take advantage of that solution as a startup. So it's very high pressure, very high risk stakes in play. That's what really a startup is. The difference between a startup and a small business, you can open up a restaurant and you're going to be basically trying to generate profit from day one. A startup is you're very aggressive. You want to put that plant in the ground, you want to water it, fertilize it, you want to get it to grow very quickly in a short period of time. That's the idea with a lot of these startups. In some cases with some of these startups, what can happen is their ideas eventually can be scooped up by other companies, or they do so good at it they're able to keep the company sustainable. And that's something that's to watch out with them, that some of these startups can become very big companies. How can they fail? Well, most of you will be familiar with the 4 P's of marketing, which are product, placement, promotion, and price. If a startup goes in and doesn't have a good product, it's not going to succeed. If it can't place it properly with proper distribution and reselling, it's not going to succeed. If it can't promote it and advertise it and get brand recognition, it won't succeed. If it doesn't have the right price point, it won't succeed. So that's a startup in any business, but in a startup it's more risk. The other thing is startups can also fail due to the lack of cash. And that means either they're not able to raise the money in venture capital markets through seed funding, or whether they're able to do IPOs to get that cash in, or they have enough internal cash reserves to do it. That's the critical aspect. How do they succeed? Well, typically when you've got good startups, you've got good management. And usually they understand that particular market niche. They've either had experience from an ex-sales rep, general manager position, or even in a development perspective to know the market. So they have that quick relationship building that they can use and leverage as part of moving their products to market. And they can gradually add people on as they see fit as part of building the model out. Strong product. They believe in their product. They believe the product it has that position in the market, that it has a niche market. They've done their research, so they're able to sell it. They've got strong marketing plans, whether that's through digital media, through social media. They're able to leverage some of those marketing plans to make them specifically target at niche markets to get bang for their buck. That's how they're able to do it. How do startups typically compensate? Well, they'll pay salaries and benefits, but in most cases they'll tie a lot of it to stock options, because that's where the risk is. They're going to try to entice people to come in and to work with them to the feel that they'll get stock options returns as the business succeeds. What's the government role? Well, in a lot of cases governments will create what they call as innovation funds. They'll provide that working capital to help some of the startups. The other thing is the taxation things. Usually with startups they start small, so the corporate tax rate tends to be small. They'll try to minimize payroll taxation by looking at their headcount issues. Stock option deduction is another way to kind of reduce the tax burden, and then R&D programs as well as to capture that. How do startups attract new investments? Well, typically what they do is they try to put a business plan together, show the returns of that business, to show you where they think they're going to be in 1, 3, 5 years out. Now it's up to the investor to assess those plans, whether or not they're valid. They shouldn't take everything at face value. They need to do their own assessment of that company, the management, the product, and compare it to its peers and where it's entering in the marketplace in terms of a solution. They can attract venture capital, go out there and bring somebody that's willing to take high risk at high demand in terms of capital. They might even try to do an IPO, which is initial public offering, to raise some cash in terms of some of the venture capital exchange markets. They'll try to bring some cash in internally from the directors as part of trying to fund it. This chart basically, or page, just shows you the top 20 fastest growing companies in Canada. If you look at them, they're a combination of sectors, and they're basically showing you. So typically what happens is they start from nothing to build it up to something. So it takes very aggressive strategy to grow quickly in a short period of time. And usually when you see success like this, it's usually to do with the management team, usually deals with people that have relationship building, usually to deal with who they're targeting, and they're able to build from the grassroots up, from government contacts to actually business contacts, to grow a business pretty quickly. You probably have aggressive sales forces to do it. Now, like anything else with this presentation, it's up to some of you to assess startups. Startups are a critical aspect of growing an economy. They're also high risk. And it's up to you to kind of define those risk factors when you're looking at things, but to also understand that startups have a role as part of the economic, or the economy is growing an economy, because they provide opportunities for people to take risk. Whenever there's risk, there's return, but there's also loss. And that's something people don't understand when they start reading up about startups, that they typically are high risk, but they can have a good return. But it just depends on the company, and that's up to the individual to do the research on all aspects of that company, includes the management, including the product, including just the overall plan, to see how it fits. Nothing should ever be taken at face value, and that's what this presentation is designed for. Thank you.